So thanks a lot to the organizers for having us as part of this conference. The title of the paper is The Financial Origins of the Rise and Fall of American Inflation. And this is joint work with my frequent co-authors, Itamar, Drechsler, and Alexi, Savov. So what this paper does, it sort of revisits a period which we think is very important, the period of the Great Inflation, which is usually dated from 1965 to 1982. And we would argue this period was very influential, in fact, formative for a lot of macroeconomics and in particular for monetary economics. And the reason why it's so important is because it's a time when inflation got out of control, despite very high interest rates, the Fed raising interest rates to up to 20%. It's also a period where arguably there was sort of a crisis of understanding. So the old Keynesian toolbox sort of stopped working. We saw high inflation and high unemployment, something we call stagflation. And so both academics and policymakers didn't quite know what was going on during that time. Now, I think it's fair to say that there's been a giant literature on this topic. And so it's very hard to summarize it in one slide. I think actually Raghu did a wonderful job sort of, summarizing it earlier. I will do an attempt here. Basically, one way to think about it is sort of a standard narrative which emerged out of that which blamed the Fed for the rise of inflation. And the intuition is basically that the Fed didn't raise interest rates aggressively enough. And one way this was sort of formalized is in two papers by Clarita, Gall, and Gertler, building on earlier work by Taylor, is just saying that the Fed didn't raise interest rate more than 1-for-1 with expected inflation. And so the real rate was actually going down. And so it wasn't stopping inflation. And so in a sense, the Fed lost credibility because people were expecting inflation because the Fed wasn't stepping in. Inflation actually happened. And so you had a self-fulfilling equilibrium. So under this narrative, and if it goes according to the popular narrative, what ended this? It ended, by Volcker coming in. He restored Fed credibility. He raised rates, kept them high, despite inciting a very severe recession in the early 80s, kept them there until inflation was coming down. And since then, we have seen lower levels of inflation, less volatile inflation, also longer expansions of the business cycle, something which we call the Great Moderation. I think a lot of people, as Raghu suggested, think that this is due to the fact that the Fed had learned its lesson and got better at implementing monetary policy. So arguably, this sort of credibility view underlies monetary policy theory in practice up to today. So let me just show you two figures which are going to make this point, just to make sure we're all on the same page. So what I'm showing you here is just sort of Fed funds rate and CPI inflation. That's annual over the following year. Starting in the early 60s, and you see sort of in the 60s, inflation was really low, around 2%, just where we are today. And then it started rising in 1965. So the economy was really hot at the time. There was the buildup to the Vietnam War. And then you can sort of see inflation rising over the next 17 years. And that is 3 cycles, but the high of each cycle is higher than previously, and the trough is also higher. And then Volcker came in 1980 and sort of restored credibility by raising interest rates, and you see inflation coming down. The other important aspect is the stagflation, so there's the stag part, namely that real economic activity was declining every time inflation was going up. So it's easy to see sort of the negative correlation between inflation and GDP growth, and that sort of contradicted the Phillips curve, which was the way a lot of people were thinking about it at the time. And also I want to point out GDP was very volatile. So you had 4 recessions over a relatively short time period. So what is this paper about? So we argue, propose, and test what we think of as possibly an alternative explanation for the Great Inflation. And the way we think about it is it's really financial repression. So we focus on the US, but inflation was rampant across the world, not just in the US. There was some interesting variation across countries. I'm going to come back to that. But for the most part, most countries had some form of financial repression. It took different forms in different countries. And so to really dig in, we're going to focus on the US. But if there's any interest, I have more to say about other countries during the Q&A. So in the US, financial repression, we argue, took the form of an important law, namely Regulation Q, which was imposed and then later repealed. So what's Regulation Q? It's a law which places hard ceilings on nominal deposit rates. So we argue that at the time, maybe even today, deposits were the main form of liquid savings for most households, but not all, which is going to be important. So for most households, a large fraction of them, Regulation Q suppressed the return to saving, and it also disabled the transmission of monetary policy to households. So as the Fed funds rate was increasing, it wasn't passed through to depositors. So let me show you what that means in the picture here. In black, I'm just adding this ceiling rate. This is for savings deposits, but there was a slightly higher ceiling rate for time deposits, and then checking deposits we also had a ceiling, which was 0 at the time. The savings deposits are plotted here because that was the main form of savings of deposits at the time. And so in 1965, the Fed decided to let that bind. So Regulation Q had been around before that, but they made a conscious decision to let it bind. I can talk more about why they did that. Our reading, our understanding of the literature is they actually thought it would reduce inflation. So there was a sense in which, well, Regulation Q, going to limit the increase in deposits that I will show you. So that's going to limit money growth, and that should reduce inflation. But importantly, then after that, there was no pass-through of the Fed funds rate to the deposit rates. So what did that mean for the real deposit rate? So that's now what you have sort of in yellow, beige. Basically, real deposit rate was plus 2% in the early 60s, and it went down all the way to minus 8% by 1979. And I should say, in contrast, the literature has focused mainly that the real Fed funds rate was too low. So that's the difference between the red line and the blue line. So if you think 0 was too low at the time, then minus 8% is definitely too low. And if you want to think about the cost, not the welfare cost, but the cost to depositors, one way to get a back of the envelope magnitude is to just sort of take the change in the real deposit rate. So that's minus 8, this is 8%. And then multiplied, by the amount of deposits, and we scale it by consumption. If you want to think about the depositors, how much did they have to pay to hold these deposits? It's roughly 4% of consumption. So that's big. That's the magnitude of a recession. You have to pay that effectively every year. So how would that, cause inflation? So the idea is the following. So once you suppress the return to saving, you have a greater incentive to spend. So aggregate demand is going up. That's going to put an upward pressure on prices and going to lead to higher inflation. Now that can accelerate in the sense that once you have high inflation, it's going to lower the deposit rate. It's going to increase aggregate demand even further, and therefore increases inflation even further. So the intuition is actually not new. It's very similar to the normal rate pack, which Milton Friedman described in his famous presidential address in 1968. It's just here we're sort of pegging the deposit rate, not the Fed funds rate, and it's Regulation Q, which is pegging the rate. Now, how does it play the stack part? Why did output go down? So that's sort of the second piece here, how a financial friction like Regulation Q could potentially cause a decline in output. So the idea is you have this low deposit rate, but you have deposit outflows. So, this addresses possibly Raghu's first point where he said, well, where did the money go? So the idea we have is that there's sort of a set of depositors which are, inattentive, maybe less sophisticated, maybe they really value deposit insurance. So those are the ones which are stuck in the financial system. So those are the ones who sort of going to push up aggregate demand. But the other depositors who want to get out, and so they're going to put their money into other assets. At the time, we think a lot of it went into housing. It also went into treasury, some of it in the stock market. But the important point here is that banks lose funding because deposits are flowing out. So it leads to a disintermediation of the banking sector. And if the banking sector can't get funds elsewhere, you end up with a credit crunch. And so bank-dependent firms going to be constrained, and so output going to fall and unemployment going to rise. You can think about it as sort of the aggregate supply curve shifting inwards. So let me show you some aggregate evidence on the deposit. So here what I'm plotting is real deposit growth and real bank asset growth. And what you can see is every time inflation went up, basically deposit growth declined. So if you know our earlier work on the deposit channel, that's basically the deposit channel on steroids. And you can see it sort of starts right when they basically made Regulation Q binding. So the first time this happened was in 1966. And that's actually where the term credit crunch comes from. That's the first time people used that in the literature. And you can also see that banks didn't really have the ability to substitute to other sources of funding. So asset growth and deposit growth went hand in hand. So I should say, something like the euro dollar market developed right around the time, same with money market funds. They were very small. We think of them as actually as a reaction to regulation Q. So that's what you get when you have a big friction, but they weren't large enough in order to offset this effect. So arguably today it might be different where you have a bigger shadow banking system, but at the time, the banking system was really central. And so just to show you that lines up with, output growth. So you had high inflation, a low real deposit rate, you had deposit outflows. And so that's exactly when GDP growth went down. Now, one interesting aspect is, how did it all stop? So what ended the great inflation? So it turns out regulation Q was effectively repealed in the late 70s. And the way they did it is they didn't just get rid of regulation Q. Instead, what they did is they introduced new deregulated deposit accounts. And so the rates on these new accounts immediately shot up far above the old ceilings. And importantly, households actively took the money out of the old accounts and put them into the new accounts. So in today's terms, we see 3.5 trillion of deposits moving from the old to the new accounts in roughly a year and a half. So arguably, that's sort of another pointer towards the fact that this regulation really was binding. Once it was removed, that reduced incentive to spend, and there was less pressure on prices. And I show you here in the picture, basically in black, you have two lines jumping up. The reason is there's sort of two accounts were introduced. First one were money market certificates in 1978, the third quarter, and then a year later, small saver certificates. And you kind of see the jump up in the deposit rates, and the pass-through was restored in the sense that the black line then co-moves with the Fed funds rate, the blue one. And if you want to think about it in terms of the real deposit rate, which I emphasized beforehand, basically what you find is that it went from -8% to 0% in 80 and plus 4% in 81. And in terms of the timing, I think in the time series, obviously very hard to disentangle these things. That's, as I'll show you later, we'll go to the cross section, but it sort of happened around the same time as Volcker raised interest rates. Now, one thing which came up in Raghu's discussion early on as well is like, what does it mean for savings? So the one thing we have done actually, and I don't know whether it addresses this point, it's not in the paper yet, but when you think about savings, you think about trading of consumption today versus tomorrow. So you think about the Euler equation, and people have looked at this evidence. In particular, I think of a paper by Campbell and Menke. You haven't found that the Euler equation doesn't seem to hold. Basically, that's what they found. Now, if you replace the real Fed funds rate, that's what people use in the literature, the difference between the blue and the red line, with the real deposit rate, then actually it looks like the Euler equation holds reasonably well. So you get an applied EIS of around 1, and so consumption growth is really highly correlated with the real deposit rate. So in terms of trading off consumption today versus trading off consumption tomorrow, we think this is actually consistent with the idea that households actually responded to the change in interest rate. Okay, so what I want to do in the rest of the talk is I want to give you a bit of a sense of, is it possible that there's a causal mechanism going from regulation Q to inflation? So what I will do is I will sort of pull out the tools of applied micro and show you some natural experiments which potentially address that question. Before I do that, just to give you a little bit more history of where did regulation Q come from, is it actually came from 1933. It's a very sensible idea. Basically, it was there to prevent excess competition. So if you had risky banks which were sort of gambling for resurrection and offered very high deposit rates, sort of regulation Q was supposed to take care of that. And so the way it was implemented, it wasn't really binding for most banks. It just sort of took off the top of the banks which offered very high deposit rates. And then in 65, there was a decision to change this, to actually let it bind by not raising it, as I've done previously, with the idea that going to slow money growth and credit growth. So our understanding, based on the reading of the literature, is they thought that actually going to reduce inflation. And again, this sort of was similar in other countries. So in the UK, you had the so-called corset system, which, the idea was it really was strangling the intermediation sector. So this was something which was quite widespread, not just in the US. Okay, so what are we going to do in the cross section? So we would say the aggregate time series at least sort of consistent with the idea that regulation Q may have contributed to the great inflation. So now we're going to look at cross-sectional variation exposure to regulation Q and look at its effect on inflation. And the reason why we do that, as always, we think we can potentially control for aggregate economic condition, and that may help us to sort of control for alternative explanations, such as Fed credibility. Now, the identification challenge here, I think, is pretty clear. You may be worried that variation exposure to regulation Q and inflation may just be responding to other local economic conditions. So that's the omitted variable. You may also think that regulation Q is just going to respond to expected variation in inflation. So what we have done to try to address that is we sort of looked at 4 natural experiments covering the rise and the fall of great inflation. So in the interest of time, I sort of going to focus on the first 3. The 4th one is in the paper if you're interested. So I should tell you what data are we using to do this. So you need data on deposits and inflation. So the deposit data, we effectively use bank call reports. The chunk of the work here was sort of extending the call reports to go back in time. So we got that data from the Federal Reserve, and a lot of work went into sort of setting them up. But that's what we're using here. We also use data on the SNLs, basically the financial reports. It's the equivalent of call reports, but for the SNLs. The reason you have to do that is SNLs were pretty large at that time, roughly a third of the financial system. And they had a different regulator, and so therefore we had to collect them from a different data source. Now, in terms of inflation, we're going to use 2 measures of inflation. One is CPI inflation, so that comes from the Bureau of Labor Statistics, and that covers the 25 largest MSAs. And to extend our sample, we're also going to look at wage inflation. So we basically look at nominal wage growth, and we have 2 different surveys, one covering all private sector employees and one covering manufacturing employees. They started a little bit later, but then have broader coverage. Now, Raghu has raised the point of, do we really expect to see variation in inflation, within the US? So if you have a monetary union, everything is tradable, you would think that there shouldn't be any difference in inflation. Now, exactly as he actually suggested, if you have non-tradables, you may see, that there is a variation in inflation. And I think that's exactly what we see in the data. I think it's also what you see in Europe within the monetary union. But obviously, these might be temporary. So to the extent that they're temporary deviations, I think we would potentially underestimate the effects. But we can come back to that later. Okay, so the first experiment is sort of at the onset of the great inflation. So as I said before, regulation Q became binding for banks in 1965. Now, interestingly, SNLs initially were exempted because they had this different regulator. It was the Federal Home Loan Bank Board, not the Fed regulating them. So it took them a year and a half to sort of follow the Fed. And so for this brief period, basically, regulation Q was arguably less binding in areas which were dominated by SNLs. So according to our theory, these areas should pay more competitive rates and therefore see less of an inflation increase. So that's what we're going to look at. The identification assumption here is that the SNL share is predetermined and not picking up other factors driving inflation during the onset of the great inflation, which we think is plausible. So here you have it in terms of a picture. The table is in the paper, but basically in terms of the picture, what we do is we just run a bunch of cross-sectional regressions where we regress inflation on the SNL share. And what you see is basically there's no difference between areas which had a lot of SNLs versus areas which do not before 65. So there's no pre-trend in any way. Once the regulation became binding on the commercial banks, basically what you see is that the SNL dominated areas had a smaller increase in inflation. So that's what it means to have this negative coefficient. And then this sort of disappears once the SNL become subject to regulation Q. So we think that sort of the dynamics of this effect are very much consistent with the idea that the limited pass-through of Fed funds rate to deposit rates for the commercial banks during this time, but not that the SNLs can explain the inflation. In terms of the magnitude, I would say that the coefficient is sort of consistent with the kind of aggregate increase we saw during that time, which was roughly 3%. It was just the start of the great inflation. Okay, now that brings me to my second experiment. Let me say right away, I think the second experiment is actually sort of the most well-identified one. It's not economically the most important one, but still we think is actually a setting where we have a very nice natural experiment. So we call this a now account experiment. I should say that's not our name. That's the name which it got in the literature in the 70s, at a time when they didn't really think much about natural experiments anyway. What is the experiment? So the story goes as follows. In 1972, there was a small bank in Worcester, Massachusetts, just outside of Boston. And that bank created a now account. So what's a now account? It's basically a checking account which pays interest. That violates Regulation Q, but this bank felt like, well, maybe we can get around it. So rather than paying 0% on checking, which you had to do under Regulation Q, they decided to pay the rate on savings deposits. So technically, it was a savings deposit. So they paid 5%, which was the ceiling rate on savings deposits at the time. Now, not surprisingly, other banks did not like that. They said it was unfair and immediately sued for unfair competition because it violated Regulation Q. Now, this lawsuit basically made its way for the courts very quickly. And in a surprise move, the Massachusetts Supreme Court actually authorized now accounts, but only for state-chartered banks, with the logic that the state-chartered banks are not subject to Regulation Q, only the federally chartered banks. Now, most commercial banks were federally chartered. So what they did is now they went to DC and asked Congress whether they could also offer now accounts. And so the experiment here is in 1974, Congress authorized now accounts, but only for Massachusetts. They threw in New Hampshire as well because the Boston metro area overlaps with New Hampshire, so you can't really sort of separate Massachusetts and New Hampshire in terms of banking. But only for those two states, they allowed these now accounts. And it was hugely popular. So within a couple of years, basically Massachusetts, 80% of households took up this now account. And so over time, you had a staggered rollout because basically in other states, especially in border towns, banks felt, again, this was unfair competition. So they started lobbying Congress to have this exemption as well. So I can show you that in terms of a map. So here, this is sort of a map of the Northeast. And you're going to see here, basically in blue, you have New Hampshire and Massachusetts. So that's where it was authorized in 74. And the red dots, where we have data. So these are MSAs. And so what you see is that basically, the competition with other New England states was, where basically it was first authorized. So in 1976, it was expanded to the rest of New England. After that, it was expanded to New York and then New Jersey. And, finally in 1980, basically it was expanded to the rest of the US. So what we're going to do is basically think of this as a partial repeal of Regulation Q. It was just partial because it didn't reestablish the transmission. It also just sort of affected checking versus savings, but still, we think it's well identified. So we just use sort of the standard identification design for a staggered rollout. So we're going to regress inflation in, MSAI at time t on an MSA fixed effect, time fixed effect, and then we have a dummy variable deregulate, which turns on if an MSA actually allows now accounts. And so the identification assumption is that this rollout was driven by this geographic proximity to Massachusetts, not by expected local inflation or economic activity in those areas. So here again, sort of the result is in terms of a picture. Basically, what you see is that when this regulation came in, Massachusetts and New Hampshire, relative to the other states, saw much lower inflation. So it seemed to come in pretty quickly. Then when it was expanded to the rest of New England, so that's when Connecticut, Maine, Rhode Island, Vermont came in, they switched basically from being control states to treatment states. You still see a negative coefficient. Coefficient is smaller, arguably because literature argued at the time that there was less competition there, so it was a little bit less take-up, but it's still negative. And you see the same effect with New York and New Jersey, and then in 1980 everybody comes in, at which point you can't identify.
Philip, I wanted to jump in here with the question,
yes.
if you can. Could you, so this way of plotting things I think is reasonable, but it seems like you could also do this in sort of just a pre-post deregulation and pull all of the things, which would let you look at pre-trends. I mean, I think the identification is probably plausible, but is there a reason you don't do things that way?
So I think I know what you mean, but I'm not 100% sure. If you
basically just do it as like an event study, where you're in one group before deregulation and you're in the other group after deregulation, and then you just look at before and after.
I would be happy to do that. We haven't really plotted it that way. We
Okay.
thought that was one way to show it graphically, but I think I would be happy to do it the way you suggest. I mean, what we have done so far is, in the table basically, which I'm putting up here, is we did it for all measures of inflation which we have at that time, and so we did look at it at CPI inflation, at wage inflation, using basically all employees, and then at wage inflation using just manufacturing. So what we liked about this is basically that you find a similar coefficient for all of these different inflation measures. And the one thing we have done is, in columns 2, 4, and 6, we also control for economic conditions. So if you're worried that we're just picking up economic conditions, that's not the case. You find that economic conditions are actually significant. So they come in, they have explanatory value for inflation. They don't affect the coefficient of interest.
Mm-hmm.
But thanks for your comment, Joe. I think
yeah, I mean, I think the broader point is just like, trying to assess parallel pre-trends in some sense. And then on this slide, I had like a related question, which is, I mean, so you have MSA fixed effects here, but it would be nice to like show comparisons like on observables for these things, really for all these specifications where you're sort of comparing it implicitly like treatment and control group, just to show that they're similar on observables.
Yes, so that's not in the paper yet. So I think that's another good point. So we're all happy to add that. Okay, so this was my second experiment. Now I want to get to my third experiment. So this experiment, I should say, we think is economically the most important one. Potentially, it's a little bit less well identified than the last one. But let me tell you why I think it's important. So this is sort of getting back to the aggregate graph where we looked at the deregulation of the introduction of these two deregulated accounts, money market certificates and small saver certificates. And those were most similar to small time deposits, I should say. It's most similar to CDs. What we want to do is examine the impact of the local take-up of these deregulated deposits on inflation. Now here, I think the identification challenge is very clear. You may be worried that, if you see an MSA taking up more of these, small time deposits, these new accounts, maybe it's something about that they're responding to local economic conditions or they're responding to expected inflation. So the one thing we can do is we can actually instrument for the take-up. So what we're doing here is, we are basically exploiting the fact that these new regulated accounts were similar to small time deposits. So arguably checking savings time deposits differ in the maturity and the liquidity, the sort of imperfect substitutes. And so the take-up should be larger in places where you already had more small time deposits. Now, we don't explain necessarily the variation in small time deposits, but the one thing I should say is we measured as 1975. And so at that time, economic conditions were quite different from 1978. So to the extent that you're worried, it's just picking up economic conditions. I think measuring as of 1975 somewhat addresses that. Now this is the OLS. Let me just skip that. It's large, but potentially endogenous. And so if you do the IV, this is sort of the first stage. This is a bin scatter plot. So we have more than 300 MSAs. So, each bin here is roughly 15 MSAs. And what you can see is that if a metro area basically had, more small time deposits in 1975, that predicted whether it, took up more of these deregulated accounts early on. And so that's what we're going to use in these regressions. We basically instrument for the MMC share with the 1975 small time deposit share. And we find a relatively large coefficient. We also control for past inflations. You might be worried that we're just picking up regression to the mean. Maybe some areas just sort of have a higher beta with respect to aggregate inflation, but that doesn't seem to be the case because we can control for it, and it doesn't affect the coefficient of interest. So the magnitude of that is sort of consistent. I should say is consistent with the drop in aggregate inflation which we observed during that time. Obviously, there could be other things going on, but if you want to interpret the economic magnitude, it's actually quite large. Now, there's also evidence on the timing here, so you can look, when did that actually happen? The point is that, cross-sectionally, inflation really started to decline in sort of the exposed areas right when these deregulated accounts came in, even though aggregate inflation was still increasing at the time. So that's consistent with these deregulated accounts really having an effect on inflation. Now, one other piece of evidence that's not in the paper yet is on the international dimension. So I just wanted to say one word on that because we look within the US, but obviously another way we want to look at it is across countries. So as I said before, a lot of countries had inflation, but the one country which had relatively low inflation is actually Germany. And so here I'm plotting inflation, the local equivalent of the Fed funds rate, and the deposit rate on this graph. And the one thing which is interesting is people had written papers about the fact that, in some sense, inflation never got that high in Germany. So there's a famous paper which sort of says Germany was opting out of the great inflation. In terms of our explanation, you would be wondering, well, why did Germany have less inflation than the other countries? So it's interesting. Germany actually eliminated the equivalent of Revolution Q in 1967. So they got rid of it. And what you see in terms of deposit rates is they were much more sensitive to the short rate. So this kind of lack of transmission mechanism wasn't happening in Germany. So I think at least that evidence is consistent with what we are seeing. Now, a lot of other countries had inflation which was very high, like the UK and other countries. We're sort of looking into those in more detail. So far, we have done Germany and the UK. They seem to be consistent with our explanation, as far as we can tell. Okay, so let me summarize. So the paper is sort of arguing that financial repression played a big role. And the way it played out in the US was with Regulation Q, which disabled the monetary policy transmission. So basically, we argue if serious financial friction, not necessarily the Fed's policy rule, was to blame. And so once the friction was removed, inflation sort of returned to low levels. And in terms of the stagflation part, as I argued before, the credit crunches potentially can explain why that happened when inflation went up. Now, it's a historical paper, but we think if you take the results at face value, it has implications beyond that particular period. So let me just sort of mention two possibly. So the first one is, if the low inflation after 1982 is not just due to aggressive monetary policy, as conventional belief, you may be less worried about the fact that being less aggressive is going to lead to more inflation. So a number of people have argued since 2008 that inflation is just around the corner, and often it's sort of invoking the experience of the 70s. But you might be less worried about losing your credibility if it's not that central to begin with. So that may be explaining why inflation is not just around the corner, and it affects policy decision on the margin. At least our reading in 2015, this idea that inflation might flare up again was sort of partly responsible for the effect to raise. It's also obviously an issue which came up when Jay Powell recently announced that they want to move to average inflation targeting. So that's one aspect of how that plays out today. The other one, and this sort of builds on what Raghu said earlier, potentially this can reconcile what we see at the zero lower bound with what we have seen in the 70s. So the idea is quite simple. So Regulation Q effectively put a ceiling on deposit rates, and we argue that led to high inflation. Now, one way to think about the CLP is basically puts a floor on deposit rate. At least retail deposit rates have a hard time going below zero. And so if you have a floor, that potentially can lead to low inflation. So, possibly this sort of explanation, this framework can help us think both about the 70s, but also about what's going on right now. Thank you.
Okay, great. Thanks so much, Philip, for being so on time. Joe, the floor is yours.
Okay. Can you see my screen?
Yes.
Okay, great. Yeah, thanks for inviting me to discuss this paper. So let me start out just very briefly summarizing it, which probably isn't necessary since that presentation I think was quite clear. So the argument of the paper basically is that Regulation Q prevented banks from raising rates. And as a result, it then prevented the pass-through of the federal funds rate to households, and then kind of as a implication of that, then caused the great inflation. In more detail, basically, even though the federal funds rate rose substantially in the late 70s, the effective rate stayed low, or actually was declining as inflation took off, or the real rate. So you had this inflationary spiral as a result of this rate cap. Then inflation ended when Regulation Q ended, and the pass-through of the federal funds rate was restored. So in the paper, I think even a little more than in the talk today, it emphasizes a lot that the end of Regulation Q and the peak of inflation was 3 quarters before the Volcker rate hike. So kind of suggesting that it wasn't Volcker raising rates, kind of the traditional story driving the end of the great inflation, and was instead the end of Regulation Q. And then there's a bunch of cross-sectional evidence. That's kind of the bulk of the paper, showing that locations where Regulation Q was binding saw smaller local inflation. So for example, like high SNL shares are associated with lower local inflation rates. So I think what I'm going to do is kind of talk through, and mostly on the measurement side of this rather than thinking about the mechanisms. So I think in sort of the big picture, I think this is an intriguing idea. It's a pretty bold claim in some sense that the conventional wisdom is wrong, or maybe that's too strong of a statement. I guess it doesn't necessarily need to be that the conventional wisdom is wrong, but at least incomplete. I mean, both of these things could be important in practice. And I would say I'm definitely broadly sympathetic to the idea that thinking about financial frictions and kind of institutional details matter for monetary transmission. So less on the deposit side, but more thinking about borrower behavior. A lot of my own work recently has been focused on exactly thinking about those kind of frictions, but on the mortgage market side. But what I want to talk through is that I think I do have some concerns, especially in kind of the aggregate time series, kind of thinking about the underlying data and the extent to which some of the correlation patterns kind of hold up, potentially with alternative data series. So first, kind of just showing the aggregate time series here. I think I'm doing this at a slightly higher frequency than what they are in the paper. So there's a little bit more high frequency variation, but this is just showing in black the CPI inflation rate against the federal funds rate. And so essentially, one of the points they're emphasizing is that the inflation rate is basically peaking here, roughly a year before the federal funds rate peaks. And this is kind of around when Regulation Q ends here. So as sort of the evidence for, or at least suggestive evidence that the repeal of Regulation Q was actually what was ending the great inflation. I just want to sort of go through a number of potential issues with just the CPI measurement and see the extent to which different sort of data sort of methodology considerations affect the sort of patterns of inflation here. So one thing I think it's important to note is that the main CPI series, which I think is what they're using in this series, sort of the headline CPI, is not updated across time as methodology has changed. So I would say the old methodology, I mean, bad is maybe too strong of a word, but I think like it was problematic in some dimensions that might be important for this period. So for example, until 1983, the shelter component of CPI directly included house prices, and it also included mortgage interest rates. So one reason that might be important is there was a very large spike in decline in mortgage rates in 1980 Q1. So my first suggestion about kind of a methodological change is to switch from the headline CPI to using what I think they now call the CPI retroactive series, or in the past it's been called the CPI research series. But it's basically sort of redoing the historical CPI, but using the current methodology retroactively. So it's sort of a CPI series with consistent methodology across time. So this shows the effect of switching to that series. Just that change alone doesn't make like a huge difference for things. It basically, you still get the result that inflation still peaks before the federal funds rate peaks. But that kind of leading thing, I think, is a good amount more muted. So, it's not sort of this huge spike here and then rapid decline. It's kind of more of a plateau in some sense. So that's the sort of first change that I would suggest. The second is noting that there is another like sort of what I would think of as kind of like idiosyncratic thing going on, right at the end of 1979, beginning of 1980. And that's that we had the Iranian Revolution and this gigantic oil price spike. So this is basically a huge transitory increase in oil prices, and then a huge decline in oil prices. So in light of that, I mean, I guess it's debatable, exactly what CPI series you want to be looking at, but I think it's useful to look at what's happening to core inflation. And when you do that, if you look at sort of core CPI using this consistent methodology across time, that actually then does make a pretty big difference for these timing things. So then it really pushes back the peak of inflation, by a solid year or so. And at least to me, looks much more like the sort of traditional Volcker narrative, where you have the inflation rate basically peaking around the time that the federal funds rate peaks. So this is with that retroactive core CPI. I was sort of curious, if you look at other inflation measures, the extent to which these things kind of look like, one or the other of these CPIs. Here's looking at things with the GDP deflator. If you do that, I think, again, it sort of looks like this, peak is relatively later than using the headline CPI inflation rate. And we don't have like great measures of wage inflation that, don't have sort of composition concerns in the background, but we can just look at, for example, average hourly wages. And again, those have a lot of composition problems. But if you look at sort of the peak of wage inflation, it's also on the later end there. So to me, I think these inflation patterns suggest more like the traditional narrative and not that inflation peaked before the Volcker rate hikes. But I don't want to lean too much. And the paper, has caveats on this dimension too, on interpreting a few quarter aggregate time series difference. There are, lots of confounding things, and it's hard to interpret high frequency time series stuff. So most of the paper, I think, is rightly devoted to cross-section evidence, looking at how local inflation is related to how binding regulation Q is locally. So I think this is all nice and well executed, but keeping in sort of the similar spirit of thinking about the underlying data measurement, I do have a concern about what I think is the primary local inflation measure they're using. It wasn't totally clear to me, so another suggestion I have is just being a little more clear on that. So let me talk through that, but with noting up front that several specifications in the paper look at wage growth. I don't think that's subject to this concern. So this isn't kind of a concern with all the results. And it's also something that I think should be relatively easy to address with a pretty simple robustness check. So I think the CPI inflation measure they're using is the total CPI from these 25 cities that the BLS publishes it for, but using the component that includes the shelter component. So if you're doing that, I think it's important to note that sort of all prices CPI with shelter in there, the cross-sectional variation in that is mostly driven by local house price growth. So like here is looking at the all item inflation rate, the correlation with the local inflation rate after excluding shelter, basically residualizing with year fixed effects. So there is still a positive correlation, but there's not a very tight relationship between the all items inflation rate and the inflation rate excluding the housing component. If you look at the relationship between the all items inflation rate and just the shelter component, there's a much tighter relationship there. So what does that mean in practice? It's basically saying that if that's the inflation rate they're using, these regressions are closer to a regression of local house price growth on savings and loan shares. So I know very little about savings and loan variation, but just kind of reading the description that's in the paper about the identification assumption, they said our understanding is that SNL variation is driven by long-run variation in local housing markets. SNLs are focused on residential mortgage provision, and higher average levels of housing activity naturally translate into higher SL shares in deposit markets. From the identification perspective, there's no reason to believe that this variation is driven by local housing markets, is correlated with inflation during the analysis period. So if what this regression is basically doing is a regression of like local housing characteristics or funding on local housing price growth, I'm not so sure that argument is that compelling, but I would basically just suggest, I think this is relatively easy to deal with by just redoing the specifications, but using the local non-shelter CPI, or even better, using this recent series that was just put out by Hazel, Hareno, Nakamura, and Steinson, where they constructed state-level CPI series back to 1978. That'll exclude some of your specifications, but I think some of them you can still use. And then that's sort of like my main comment. One other question that I had about sort of the big picture narrative of the paper is you focus a lot on kind of the savings rate, the deposit rate and the implications for savings. But the paper has very little discussion of the borrowing rate. So this is just a question I had. Regulation Q shouldn't, for example, reduce transmission of the federal funds rate to mortgage rates or bank business loans, should it? So couldn't we still have transmission effects kind of on the borrower side? So summarizing, I think it's a provocative and impressive paper. Kind of in the end, I don't really find the aggregate time series evidence against the standard narrative all that persuasive once you use what I think is arguably a corrected inflation series. But multiple things can be going on at once in the world. And I think most of the paper is the cross-sectional patterns, and I do find those more compelling. But I think, you should make sure that you're not just picking up a relationship between sort of housing finance and house price growth. So I would, suggest looking a little bit more into that.
Okay, great. Thanks so much, Joe. So to all the attendees, please, if you have any questions, raise your hands in the chat. And Philip, if you want to answer some of the concerns that Joe raised, please go ahead. The floor is yours.
Okay, well, thanks a lot for this discussion. I really appreciate these comments. I'm going to try to be short, but I want to respond quickly. So we have looked at these other measures of inflation. The reason why we didn't plot it in the paper is because they don't go back to 1965. But, we could do plots similar to what we have done. The literature has looked at that. So Alan Blind has a paper in 1980 where he says, yeah, it looks a bit smaller if you, correct for the way they treated housing, but it doesn't change the, the fact that there was the great inflation. The other thing is about the oil shocks. In some sense, the oil shocks are very important, but I'm going to be brief. The literature has sort of concluded that, they can't really explain, the one-time shock cannot explain the persistence in inflation over this long period. And in some sense, as you said, you need the narrative of Volcker, but if it's just a bunch of bad shocks, the bad luck theory, that's what it's called in the literature, then, you wouldn't need Volcker. It's just, the bad shocks have to go away. So in some sense, I think the predominant narrative is that you had supply shocks, so they were important, but then monetary policy wasn't sort of, aggressive enough in beating down inflation once you had the shocks. And so in some sense, these supply shocks are there, they're important, and we could take them out. But I think, what we are sort of responding to is sort of the narrative that it was just monetary policy which made the thing much worse.
Yeah, I get that. I more just meant like the exact timing, I think, sort of seems sensitive to the oil price.
I think, maybe there was, my point I wanted to make is sort of happening around the same time. I don't think the time series is going to allow you to disentangle it. So that point is well taken. On inflation, we would love to do it without a local shelter. So this new series which came out, you just mentioned, starting from 78, we potentially would love to use that. Otherwise, we just don't have the data. So the CPI doesn't give us this data before 78, and you have to go to the BLS and apply for it, and it takes a long while. So to the extent that we can use these new measures by Nakamura and Steinson, we definitely want to do that. It's a fair point. And then the borrowing rate, that's just sort of the history of the paper. The credit crunches now have sort of a more prominent role. We think they're really important. Actually, there were frictions. It was one giant friction, but that also raised the lending rates. So we think that's actually quite important. That hasn't made it yet into the cross-sectional analysis, but that's a very fair point. We should do that. So thanks a lot for the comments, and I would love to take some questions if there's time.
Okay, so let's go through like one or two questions. So the first question, Alessandro Rebucci from Johns Hopkins. Please ask your question. You should unmute yourself.
Patients in this practice between 12 and up.
Hello?
Hi, we can hear you.
Yeah.
Alessandro, you're muted again.
If you want, I can just read out his question because I see it. I'm not sure everybody can see it, but it's basically asking how does it relate to work by my dear colleague Thomas Philippon, which looks at the cost of finance, see that it reverted in 1965. So the short answer is I should really talk to Thomas about this relationship. We haven't thought much about it. Now, arguably, we've looked a bit at bank profitability. Clearly, this regulation Q, had a big effect on that. So I think that's a point well taken. And we think regulation Q had all kinds of effects, so it should relate to Thomas' work. I will look into that.
Okay, Sebastian Infante, he has his hand up. I don't know if it disappeared or so. Sebastian. Okay, he doesn't seem to be here. So Afsin Sahin, please go ahead and ask your question. You should unmute yourself.
I would like to ask about Walker rule. I mean, when you compare your regulation findings, and how should we judge Walker rule when we consider money books such as Mishkin? I mean, most of them emphasize the role of high interest rates during 1980s, and when Walker increased federal funds rate, inflation decreased. There's a very popular narrative, as you know. So you mentioned the role of regulation, and when you compare with central bank's policy, what do you think about that? Which one is dominant for controlling inflation?
Yes,
Regulation or increasing interest rates?
Okay. We are the newcomers to this topic, and so in some sense, there is a long literature which argues it's all about the monetary policy rules. I think we want to put up, at least for discussion, that the financial system and financial repression played a role. Now, how important each one is, I don't quite know yet. I think we're going to do more work on this. I should say, Mishkin has a very nice survey article about how monetary policy worked. And he sort of argues the bank lending channel was working reasonably well during this time and then stopped working. And I think Beneke has also sort of made similar comments. And in some sense, this is potential explanation why it worked during that time. That's what I refer to sort of as the credit crunch. So we think, in some sense, we are touching upon bits and pieces in the literature, especially the work on the credit crunches during those times, which has looked at this, but it hasn't made the connection to inflation. And so I think, it's up for debate of how much of our results could potentially account for the total variation in inflation.